in terms of downside risks. If we use that analogy of hopscotch, we can see that certain aspects of the retail investment market is still trying to play that game or that mini cycle between March and October of this year. Markets, as you know, are forward-looking, and they're certainly forward-looking, as Dean said just before. We think there's a real risk to investors not appreciating really what those forward assessments are. On the whole, we're reasonably positive for the year 2021 going forward, and that's really on three accounts. Firstly, we've got this policy of financial repression. We don't see the Fed really touching rates till late 2022, maybe into 2023. Secondly, perhaps a little bit different from others, we see significant positive upside risk in terms of US economic growth, certainly at the 4% level, but we could see that US economic growth could be 6%. And we think thirdly that plays well into something that we've previously spoken about, and that is smart industrials, particularly in developed economies, led by the US. The FANG-M stocks, currently trading at 100% premium to the S&P 494 stocks. There's, in that 494, there are fabulous smart industrial companies, trading, with forward earnings growth at 20 to 25%, on PEs of forward PEs of 20 times.
Yeah.
But you're right, in terms of China, that is our key downside risk.
So, Paul, you're looking for a big rebound in US economic growth next year, because certainly that will have some implications when it comes to the bond market and longer dated bond yields. Where does that leave those FANG stocks that are obviously priced to perfection at current levels?
Well, I think there's an inevitable outcome there. When we get to this dichotomy between the FANG-M technologies and the others, it's careful. We have to be careful not to say that we don't like many of those technology franchises. There are fantastic businesses there. The outcome that we see on that forward basis is we see sizable rotation and some significant adjustment, but we certainly don't see capitulation. But we see that there is good opportunity in terms of the quality participants in that S&P 494 to get PE contraction, and that will be to the cost of those technology positions, but not by way of capitulation.
Generally speaking, as we head into 2021, are you relatively optimistic there at Cameron Harrison when it comes to this equity market rally continuing, when you take into consideration that headline hopscotch we've been talking about, as well as political risk?
We are generally positive, Nadine. It is a unique cycle that has been created by government policy. And I come back to that that key concept of financial repression. David spoke about it in terms of how bond markets and longer bond markets might react. Monetary policy is here to suppress, and it will use all of its tools. And the market wants it to use all of its tools. And will tantrum to ensure that it does. And we think that sets things up positively for the year ahead for market risk assets, particularly equities.
Yeah, equity markets certainly can be a toddler at times when it doesn't get its way. All right, it's been wonderful to speak with you. Thank you so much for joining us, Paul, once again.